UK investors, what if I told you that conflict of thousands of miles away could wipe out most of investment gains in a few days? Right now, tension in the Middle East are shaking global markets. Oil prices are jumping, shipping routes are being disrupted, stock markets are becoming volatile. And if you invest in the stock market, whether through ETFs, pensions, or the stocks and shares ISA, this affects you. Hi, I am Rishi, your money coach. My mission is simple: helping everyday earners and immigrants in the UK take control of their finances, invest smarter, and build long-term wealth. Today, we are going to break down something many beginner investors overlook: how global conflict, especially in the Middle East, can impact investment. By the end of this video, you understand why oil prices jump during conflict, how stock markets react, safe haven asset investors run to, currency shifts and global market flows, supply chain disruptions, investor psychology during crisis, how to protect and grow your portfolio. And if you stay until the end, I will show you a simple strategy to protect your portfolio even when global markets become unstable. To understand global investing, you must understand energy markets. The Middle East is responsible for the huge portion of the world's oil supply. So when tension rises in this region, markets react instantly. Recent military escalation between Iran and the Western allies caused oil prices to surge dramatically. Brent crude jumped sharply as investors fear supply disruptions. Some reports showed that oil gaining nearly 20% in a single week, the biggest jump since the pandemic era. There were even attacks on oil infrastructure, including a drone strike targeting major Saudi refinery, which immediately shook energy markets. Why does this matter for investors? Because higher oil prices ripple through the entire global economy. Airlines pay more for fuel, shipping companies face higher costs, manufacturers face rising energy bills. Eventually, these costs push inflation higher, which can pressure stock markets. Investors' takeaways: energy stocks often rise, but sectors like airlines, travel, and logistics may struggle. If you are serious about protecting your investment during global crises like this, comment protect below and I will send you my free ISA starter guide showing beginners how to invest safely in the UK. Next, we look at global stock market volatility. Whenever geopolitical tensions increase, stock markets react immediately. Investors hate uncertainty. Recent Middle East tensions triggered global volatility. Markets across the world dropped while energy companies surged. Analysts warned that this conflict could create the largest weekly drop in global stock in years, even if tensions continues to escalate. So next, we look at the safe haven assets. During crisis, investors search for safety. These are called safe haven assets. Examples include the gold, government bonds, the US dollar, certain commodity ETFs. When global tension rises, money often flows into these assets. Gold, for example, historically rise during geopolitical shocks because investors see it as a store of value. Adding some safe haven exposure to your portfolio can help reduce volatility. This doesn't eliminate risk, by the way, but it helps you stay invested during turbulent periods. Next, we look at the currency market's effect. Conflicts don't just affect stocks and oil, they also impact currencies. During global uncertainty, investors usually move money into the US dollar, which is considered a global reserve currency. This can cause emerging markets currencies to weaken. The dollar to strengthen currency fluctuations in international investment. For UK investors holding global ETFs, currency shifts can actually affect your returns. Sometimes a stronger dollar can increase the value of your overseas investment. Modern companies rely on complex global supply chains. A quick pause for a second. I want to take this time out to appreciate my subscribers and the returning subscribers. And to you, if you're finding value in this video, please hit the like button and subscribe to this channel. My goal is to reach 1,000 subscribers by the end of May. And Every subscription genuinely helps. As this channel grows, it motivates me to spend more time researching and bringing you deeper insights on investing, money, and building wealth in the UK. Thank you as you do. So next, we look at tech and global supply chains. Modern companies rely on complex global supply chains. When energy prices rise or shipping routes become unstable, companies face higher operating costs. For example, tech companies rely on international logistics. So if shipping routes are disrupted or fuel prices rise, companies may face delays and higher costs. These pressures can reduce profit margin and affect stock performance. The lesson here is simple: diversification matters. So investing across multiple sectors and regions protects you from shocks in one specific area. Next, we look at investors' psychology, fear versus opportunity. One of the biggest risks during market volatility isn't the market itself, it's investors' behavior. When markets drop, many investors panic. They sell at the worst possible time. But history shows something interesting. Markets often recover faster than expected. Geopolitical shocks may cause short-term drops, but long-term investors who stay disciplined often recover those losses. Your mindset is one of the most powerful investing tools you have. So in times like this, how do you protect your portfolio? Here are practical steps beginner investors can take. Number one, diversity. Spread investments across sectors, countries, and asset classes. Number two, hold some cash. An emergency profile allows you to take advantage of market dips. Number three, long-term investing is about years, not daily headlines. Four, avoid panic selling. Emotional decisions destroy long-term returns. For example, a diversified portfolio might drop 1 to 2% during crisis, but a concentrated portfolio could drop 10% or more. Over decades, those differences compound massively. Finally, what did you learn? Middle East conflicts can affect oil prices, stock markets, currency movements, supply chains, and investors' behavior. But smart investors understand that volatility is part of the journey. With diversification, discipline, and long-term strategy, you can protect and even grow your wealth during uncertain times like this. So here's a real question. When market becomes volatile, will you panic and sell? Or will you use volatility as an opportunity to build wealth? Comment below and let me know. And if you want a simple step-by-step guide to start investing safely in the UK, grab my free ISA starter guide in the description. If you found this helpful, like the video, subscribe, and share it with someone who wants to understand how global events affect their money. Remember, knowledge is your best investment, and I'm here to help you grow it. Cheers, guys. See you on the next clip.